Unraveling Corporate Finance, Understanding Capital Structure. Hello, English language learners. Today, we're going to dive into the fascinating world of corporate finance, focusing on a key concept: capital structure. This is a term used in the finance world to describe how a company finances its operations and growth by using different sources of funds. Capital structure refers to the combination of debt and equity a company uses to finance its operations. In simpler terms, it's how a company pays for its stuff. This includes everything from buying equipment to paying employees. Debt refers to borrowed money that the company must repay over time, often with interest. Equity refers to funds obtained from issuing shares of stock, which represent ownership in the company. The way a company balances its use of debt and equity can have a big impact on its financial health and its profitability. When discussing capital structure, there are a few key terms you should know. Leverage. This refers to the use of borrowed funds to finance a company's operations. A company with high leverage has more debt relative to equity. Cost of capital. This is the cost that a company incurs to raise funds, either through issuing debt or equity. It's often expressed as a percentage. Capitalization. This is the total value of a company's debt and equity. By understanding these terms, you can start to comprehend how capital structure decisions can influence a company's operations and financial performance. Capital structure is critical because it impacts a company's risk and return trade-off. A company that uses more debt could potentially earn higher returns, but it also faces higher risk because it must repay its debts even in hard times. A company using more equity doesn't have to repay shareholders, but it may earn lower returns because shareholders will want a share of the profits. Companies have to carefully consider their capital structure decisions to balance these risks and returns. That wraps up our discussion on capital structure in corporate finance. Remember, understanding the balance between debt and equity can provide critical insights into a company's financial health and future prospects. Thank you for joining us, and we hope this lesson has been helpful in your journey to master business and finance vocabulary in English. Don't forget to practice using these new words and concepts in your own sentences, and feel free to revisit this video anytime for a refresher. Happy learning, and we'll see you in our next video.